Ladies and gentlemen, good day and welcome to the Q4 and FY23 earnings conference call of Bata India Limited, hosted by Batlivala & Karani Securities India Private Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Nikita Jain from Batlivala & Karani Securities India Private Limited. Thank you, and over to you.
Thank you, Yashasri. Good evening, participants. On behalf of BNK Securities, I would like to thank the management for giving us the opportunity to host the Q4 FY23 earnings call. Today we have with us in the management the MD and CEO, Mr. Gunjan Shah, Director of Finance and CFO, Mr. Anil Somani, and the Company Secretary, Mr. Nitin Bagaria. I would now request Mr. Nitin Bagaria to start the call with his opening remarks, post which the moderator will open the floor for Q&A. Thank you, and over to you, Nitin.
Thank you, BNK team and Nikita, and a very warm welcome to everyone. Good afternoon to all of you. We have Gunjan Shah, who is MD and CEO. We also have Anil Somani, who has joined us in April as CFO and has been elevated to board, and he's Director of Finance and CFO. We have shared the presentation with the stock exchanges a little earlier prior to this call. We'll be happy to take you through this call. We will navigate through the slides as well as the page numbers so that we stay connected. So on slide number 2, we have the disclaimer. I'm sure you have gone through the same. So we move to the next, which is slide number 3. Over to you, Gunjan, and thank you for joining.
Should we begin with the I'm sorry, sir. Please go ahead.
Yeah, thanks, Nitin. We will run through the presentation. The template is for people who have joined us in the past, should be reasonably correlatable. Okay, let's go. So we are on slide number 5, which is basically talking about some key milestones. So I think the key one that I would like to highlight here is that we crossed 2,000 points of sale for the first time in our history for sure, and obviously 700 plus cities where these points of sale are spread out. Both of them are all-time highs. We also had Sneaker Studios, which I've been talking about for some time, now spread to 500 plus stores, and a new product which we are very excited about, which is doing extremely well, continues to create records every quarter for us and did achieve the ever highest last quarter. Besides that, we did obviously continue our investments in technology and received awards on the CSR front. Okay. Slide number 6. Slide number 7. So these are the levers that I've talked about: portfolio expansion as well as retail excellence, marketing investments and making the brand youthful, exploding digital commerce, making sure that our supply chain becomes agile and efficient to cater to demand, and nimbleness and variability on the cost structures, on the foundations of talent, process, technology, and being a responsible citizen as a sustainable contributor to the ecosystem. So largely you will see updates on various initiatives across this. Many of them continue quarter on quarter and for consistency and leverage and scale. Eco growth continues to outpace our overall growth largely. Floats, as I mentioned, is something that continues to create momentum every quarter. And we have made some very promising and reasonably contributing now inroads into occasion and evening wear. That is something that we were largely absent in. I would say focused towards ladies, but also covers men. Retail excellence, store renovations continue. NPS, Net Promoter Score, is at ever highest levels last quarter. On an expansion front, we saw franchise store additions again continue momentum. And we saw in the multi-brand outlets expansion in terms of number of distributors, quality of those distributors. Marketing investments, we ran campaigns across speakers, schools and women, which helped us basically drive footfalls and the same-store growth. And obviously, as I mentioned, net promoter score from a consumer perspective, hit our values. On the digital side, the marketplace business was a little muted, but however, our own e-store as well as our omni-channel business did extremely well last quarter. NPS in our own store increased, and that is something that is a very critical lever for repeat business, as well as we saw significantly higher speaker contribution on our e-store. We did execute and stabilize the entire third-party outsourcing of our largest warehouse in the north, which is in Jamalpur, and the project is underway in this quarter for taking the next largest warehouse and outsourcing it to a 3PL. That has given us not only efficiency but also effectiveness in terms of service levels, etc. Improvement over the scenario was pre-transfer. Our optimization on costs continue. It is across, I think, corporate overheads as well as in terms of store manpower as well as in basically outsourcing the projects that I just mentioned. Last but not the least, on technology, 2 large projects, one of them completed, which is the RIMS project, which is the entire inventory management project that has got upgraded, and now it is in a manner, I would say, one step, it is readiness for a full-blown ERP that when it comes along, but it basically allows for that information to now cross-link across many other platforms of ours and therefore better decision-making. The ERP as well as the high-performance merchandising project are on track. The high-performance merchandising will go live in another 2 or 3 months, in fact 2 months. The ERP is expected to go live with the first module going live in the first quarter of year, 2021. Okay. Next slide, please. Slide number 8. Slide number 9. I'll run through some of those key parameters that we have been tracking and sharing with you. Points of sale, we crossed 2,000 plus, now at 2,053. What you do see out here is the ratio below. And as I have been talking about consistently for a long period of time, we will see expansion on the franchise and FIs from a contribution perspective because they will expand much faster, while we will have COCO expansion also happening even in this quarter as well as going forward. Franchise as well as FIs for the full year, we did ever highest additions in the year 22-23. And the momentum is pretty promising. We've got ambitious targets even for the coming year, which is 23-24. Yeah. The franchise, it just basically gives you a longer term trend line of it. We had set a vision about 1.5 years back of hitting 500. We've now touched almost 420, and we look to be much on track for that 500, maybe a year prior to what we had initially targeted ourselves. What you see in the graph below is what has happened over the last 3 years. 59 stores we added under franchise in 2021. 21-22 we added 75. Last year we added 116. And as I said, we are on track to achieve 500 much earlier than expected. We see continuous momentum in this, and it is backed by not only same-store growth in existing franchisees, but also by a couple of other parameters that we consider very important in terms of sustainable franchise business. One is the NPS of franchise stores is almost at par with now what we consider as almost sitting best in class at 80 NPS in COCO. And also, basically number of franchise stores that we open with existing partners that now contributes to almost 60% of our new franchise store additions every quarter. Yes. In multi-brand outlets, our expansion journey continues. The business has been a little tight for the last 2-3 quarters, largely because the lower price points have been under pressure. We do hope that turns around with inflation now getting moderated/flattish. But our expansion and building blocks continue, both in terms of distribution as well as in terms of categories. We did hit 1,300 plus towns. as well as weighted distribution now has touched almost 44%. Within categories, the categories that we consider as competitive edge categories, which not only drive growth but drive profitability in this, they continue to drive our growth. We have now tried to launch into two new categories. One is the sports open, and the other one is basically value-added category for ladies also. And both of these have shown good signs, and these are the two that we would like to, over a period of time, build into competitive edge categories, which are currently men's dress, which are school, as well as sandals, that is plastic. Yeah. Digital, as I said, overall had a slightly muted quarter, largely to do with marketplaces, and I think it was a temporary blip. Early signs are that we are more than making up for the gap that was there from a marketplace perspective last quarter. But the rest of the channel, which is both Omni as well as our own e-store, did extremely well. And in fact, we did ever highest number on our e-store, and it's on track to becoming almost 2x of our largest store in our network, with backed by extremely good metrics now that we have started tracking in terms of consumer experience as well as satisfaction. We did drive campaigns driven largely anchored around sneakers. School was towards the back end of the quarter, and which will extend into this quarter. And obviously our Style with Her campaign. All of this obviously helps us deliver strong SSG growth this quarter. We are also amongst the key categories that we have focused on. Sneakers continues to grow well. We will see a lot more action on power going forward, and I'll speak about that in a few slides down the line. Hush Puppies again continues to outpace, which continues the entire premiumization journey, backed by Comfort. That brand also did extremely well and a very profitable brand, as well as clothes. While the base might have been negligible, but on a sequential basis also we see continuous strong momentum. These are some key initiatives. Some of them I've talked about. Some of them we have shaped up. Now we feel more confident about how we want to take them forward. Red Label, we started off with an experiment in a single store in the north in quarter 3, that is October, November, December. We see encouraging response across key metrics, whether it's ASP, whether it's profitability, and whether it is in terms of footfalls and consumer feedback, as well as, most importantly, the age of consumers that we are attracting. And we will now want to expand this into multiple other locations. And the next store on this line is likely to come up in the next about 45 days. The next big initiative I had indicated towards this last time was apparel. We will be launching athleisure under Power brand. We've seen that, with 1.5 million consumers walking into our stores every week across the network, they do have a latent as well as obviously an actual need of apparel, and they do purchase it also. It's just that we don't offer it. I think we've got a right to, partake into that entire consumption area. And this is something that will see light of the day in the coming quarter, in another couple of months. We will be launching across 3 technologies as well as reasonably competitive price points with decent margins to boot. We will wait and watch the space in terms of further updates on this, but we feel very bullish on it. Last but not the least is clothes. While we see continuous momentum and significant growth in this category and this brand, we have also expanded our collection in this. We are also wanting to take the brand outside the Bata banner, and it will be started off with, even in this quarter, with at least a couple of kiosks, which will basically herald the clothes brand moving outside the Bata banner. We have also experimented this into the multi-brand channels, both e-commerce as well as the distribution business, with encouraging response. It already has almost 60% penetration even within our franchise stores. Other highlights for the quarter gone by, NPS, we have now hit ever highest PP. It's best in class. I think it is something that we can keep continuously plugging at, and we can even revise benchmarks on this. But I think on a normative basis itself, it's extremely strong. We did significantly invest towards training of our people and capability on that front. We have obviously the two large projects from a technology piece, while there are many others that are enabling, much better, data visibility, much more informative decision making, and quick corrective feedback wherever required. There have been obviously various events organized in terms of engagement of employees, as well as making sure that all of us are working towards the single objective of the organization. We did do a significant ERS in our southern factory in Bangalore in the last quarter, as well as we do see now some amount of benefits in terms of reduction of material pricing. Last but not the least, efficiencies in our supply chain continue. I have talked about the 3PL and similarly in our factories. With that, with the financial summary, what we did see was 17% top line growth that you see in the bar chart. We also for the full year saw significant growth, and we clawed back to pre-COVID levels of volumes. It's almost 48 million pairs, and with a average realization that was significantly higher, which I have talked about that because of the inflation we did and the GST, we had to take up prices. This is a blended realization across all our business lines. As I mentioned before, the cocoa business price per pair is very different from one which is on franchise, and this is very different from what we see from the multi-brand outlets. But this is a blended price realization. Yeah. And these are the financial metrics. I will not drain the chart because it's self-evident, as you can see on the curves. So I will not go through each of those lines. With that, I think this should be okay. Yeah, there is one more last chart. Slide number 20. Cash generated for the year has now moved to about 726 crores as we exit this year, and the ROC henceforth has obviously improved now to 20%. We expect this to keep going up as we improve our capital efficient expansion and variability in our business costs, etc., and obviously growth. So thank you so much for that presentation, and we're more than happy to take questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, they will wait for a moment while the question queue assembles. We have a first question from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, good evening, team, and thank you for the opportunity. So Bata has been sort of working a lot on premiumizing its portfolio. So just wanted to know your numbers in terms of what percentage of portfolio would now be below 500 MRP, and what was it pre-COVID, and what is your sense on this category going forward in terms of outlook?
Okay. I don't have it handy. I did mention some numbers last time. Just let me see if the team is able to rustle up something quickly. But broadly, I would say that below 1,000, we were at about 50-50 pre-COVID, and now we would be in the range of about 35 to 40 below 1,000. That number I do track it because we also did a tracking because of the entire GST and opening up price points back again wherever we could to get volume growth going back in. Below 500, my sense is out of that 35-40, we should be about about half of it, so about 20%. So both of them obviously would have declined with premiumization, which is both mix as well as price that would have taken up the mix on the higher side.
Sure. Thank you. In terms of FOFO, the contribution to overall store count is now close to 20%. Is it possible to highlight what could be the revenue contribution from this segment and what would be the EBITDA margin in this category?
You're talking of the franchise stores?
Yes, sir.
Yeah. So while we don't give splits on the business lines, but ballpark, I would say that it is about 600 to 700 points accretive from a profitability perspective at a EBIT or a channel operating margin level, which is takes care of all the nuances and only allocation costs which are neutral across business lines. So it is at almost significant accretiveness to our overall business profitability.
Because, sir, we aren't seeing that contribution coming in as of date. So possibly as this sort of sector starts contributing meaningfully, will we see that also getting reflected in your EBITDA numbers?
So it should see the whole objective of driving franchise expansion is on three fronts. One is that it allows me to open up stores in places where the brand is obviously demanded for, but however the scale does not justify me opening up a company-owned store. The second one is basically it is, as I said, it is accretive from a profitable perspective. The pure contribution that I get at an EBIT level per pair is higher than what I get from a COCO store. And the third one is basically in terms of capital efficiency. It allows me to flex expansion much faster without fixing up or deploying too much of cash. So on all these three fronts, we will see, the whole objective of doing this is to make sure that it's, step by step, it keeps on contributing meaningfully to our overall growth as well as profitability. So it gives me access to consumers as well as does it in a far more capital efficient and a profitable way.
Okay. And so my last question is, Bata has appointed Badri Beriwal as a Chief Strategy Officer who's come from Britannia. Is it possible to share in which particular vertical will he be spending more time, like COCO, distribution, FOFO, SIS?
So it is, the designation is Chief Strategy as well as Business Development Officer, and therefore driving the strategy from a consumer point of view across the organization, as well as making sure that new initiatives as well as alternative growth engines, etc., are given the right kind of leadership as well as direction, both from a strategy as well as an execution perspective.
So this is a new position, right, in the history of the company, or was this position already there?
Yeah.
Okay.
Not there in the recent past.
Okay, sir. Thank you for your thoughts and all the very best.
Thank you.
Thank you. We have a next question from the line of Nihal Mahesh Jham from Nuvama. Please go ahead.
Yes, sir. Thank you so much and good evening to the management. So 3 questions from my side. The first was that could you discuss the category-wise, and here by category I would say bifurcated into formal, casual, schoolwear, and also maybe the sneakers category where you've given some data, that how has the recovery versus pre-COVID and not versus last year?
Okay. Basically, I would say that overall we would have recorded about for the quarter gone by about 15% growth over pre-COVID. Right now, if in that I would say sneakers, the casual as well as would have outstripped the rest of the category. So comfort/casual. Sneakers and the premium segments would have outstripped, while I think most of the categories, even school, would have exceeded the pre-COVID levels. But I think these are the categories that would have grown faster than the at par growth.
Understood. Because if I say volumes for this year are similar to what we did in FY20, which are these categories? Is it mainly formal which is seeing a fall versus pre-COVID, or the school? Which are the categories which have lost share internally in our business?
I didn't get your question clearly. You asked which categories have grown, have done better versus the others versus COVID.
which you highlighted were basically the casual categories and sneakers. So I was just trying to ask the other side that which are the categories in which have incrementally seen a reduction in a share. I'm assuming formal, but anything else that you want to highlight?
So I would say the ones that are at the lower price point. So I would say, while as I said, all of them, so even school would have exceeded pre-COVID, but they would not have grown at 15%. More importantly, I think plastic as well as volume category, which is facing some amount of demand pressure, are the ones which have been relatively a little lower versus pre-COVID. I mean, relatively versus 15%.
Understood. And just a follow-up here, that is this driven by our own aspiration that maybe the inventory that we are keeping now is more premium, or this is more related to the way the market has grown?
It's a combination of both. See, premiumization is a conscious strategy, but that does not exclude ourselves from the significant amount of business that we do from the below 1,000 price point, which I answered to someone else. And we would like that to grow. And through our multi-brand distribution business, etc., we will see that growth happening. I think the building blocks are pretty much there. And there's no reason why we should not see that demand recover as, the inflation stabilizes.
So is it possible in the future the share becomes 50-50 again from the 40-60 it currently is?
Sorry, I didn't get that question at all.
I'm so sorry. I'm so sorry. I was asking that currently the share of INR less than 1,000 and plus 1,000 as you highlighted was around 40-60, 40% and 60%, which was 50-50 pre-COVID. So do you see the case that in the future the share of less than 1,000 and plus 1,000 becomes 50-50 again?
It's a little difficult to predict this. As I said, there are two levers at play. There will be premiumization across segments. Now, which segment relatively is doing better at various points in time will determine this mix. But right now, we see the premium segment relatively doing much better. So that's driving the momentum of growth. But you will also have times wherein obviously the bottom of the pyramid, etc., will start firing in, and we will see that also grow. But I think over a longest period of time, I think while last year we would have seen a significant impact of inflation, therefore an acute impact on less than 1,000, that should normalize a little. But the longer term trajectory would be that I don't see that going back to 50-50.
Point taken. The second question was, is it possible to share the channel mix for the full year between wholesale, online and COCO franchise?
So basically, COCO is about 70%. You have franchise, which is at about 8%. You will have multi-brand distribution at about 14%, and e-commerce at about, again, 10% or so.
Last question from my side. You did highlight investments in technology and marketing as a part of the press release. Any sense or quantification that you expect how much of the spend could be on a ballpark basis if you budgeted this out?
Yeah. So the IT technology-based capex that we will have outlay for this year will be in the range of about 30 crores. So I would, about 30 crores. And marketing expenditure, we will look at it continuously going up to basically from our 2.6, 2.7 levels to about 3% over a period of time.
Perfect. Thank you so much, Gunjan. I wish you all the best.
Thank you.
Thank you. We have our next question from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi. Thanks for the opportunity. So we have made a lot of interventions on distribution, premiumization, and on even brand positioning in the last 24 to 36 months. Now, when I see distribution expansion CAGR, which is 7% of last 4 years versus our revenue growth of 4%, the output actually looks a bit underwhelming. And despite putting so much effort on the premiumization and distribution expansion side, so is it that the underlying demand is so underwhelming, or have we lost market share in versus pre-COVID period?
So there are a couple of factors. I think the One is basically that as we go about expanding some of these, so let's say the franchise stores in general are at about 0.5x of our COCO stores on an average, 0.4 to 0.5x. So the turnover per store would be lower because you are entering and penetrating into cohorts that are relatively smaller, and which is why we want the franchise model to get us access there. So it's not an apple to apple. The second piece that will be there is basically in terms of multi-brand outlets. I think there is some kind of a demand pressure that has been seen over the last year on those price points which are at the mass end, and that has obviously created some amount of pressure. As I mentioned, we are looking forward to the inflation stabilizing and consumers adjusting to it. I'm sure the kind of mix that we have in the building blocks that should provide payback. So I think both of these combined together is what is providing that phenomenon. Each of these element-wise, they have pretty good, I would say, same-store growth that we are carrying.
Sure. And so if you can comment on market share and any specific segment where we would have gained market share or we are still under-indexed.
There is a syndicated data available pages on market share. The last one that we have is Euromonitor that provides us at an annual level. That shows that the market share is, recouped back from whatever hit that we would have taken during COVID time. So the last report says that. But there's no syndicated data. My guess is basically on the premium side, I think we could have participated even better than what we could have. I think on the mass side, we would have done reasonably well, I would say, from the market share perspective.
Super. So second, on working capital, again, if I map it to our 4% CAGR growth, inventory has actually gone up by 9% CAGR. Debtors have also gone up by 16%. Debtors obviously on a low base, but inventory growth is also significantly, in fact, 2 times our revenue growth. So just wanted to understand, is this the new mix in the distribution will actually entail higher inventory investment, or there are any transient one-offs in this number right now?
Anil, you want to answer that? I don't know where the inventory is. You said how much? You said 1.5x of inventory.
No, sir. 9% CAGR versus 4% growth in revenue pre-COVID.
Okay. I don't see it that way, so I am a little surprised. I would say actually we would by this year have inventory efficiency, which we measure in terms of number of days of inventory that we carry on HG, would be better than what we have ever had in our past. So even right now, I think it is at roughly at par. So I don't know where the CAGR is changing.
Okay.
Just to add, Gunjan, obviously our inventory is going, at not at a much slower pace to our sales growth. So I don't know whether this number coming from.
So we can respond separately.
Yeah, sure. I'll take it off that. And so lastly, if you can comment on.
Come back in the queue, Mr. Shah,
sure.
as we have other participants.
Yeah.
Thank you. We have our next question from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. So my first question is with regards to the investments that you're doing on the technology and also on the other ventures like marketing, etc. So do you think that these are right now suppressing the margin gains that you are doing?
Gaurav, your voice is not clear. It's cracking up.
Can you use?
Sorry. Yeah. Is it better now?
Yeah. No, this is muffled, but yeah. Okay.
Sir, if I can hear me right now?
Yes, much better.
Yeah. So my question, sir, is with regards to, you have been making a lot of investments in the technology part as well as on the marketing front. But at the same time, your franchisee is giving a better margin perspective. So do you think it is because of these investments that your cost savings initiatives as well as the incremental margins from franchise is getting masked right now? And once these initiatives are over, you could see a rebound in the margin profile?
Yeah, I would say yes and no. Yes, some part of it is that. Some part of it is also lag of capex that we had not deployed during the COVID period of couple of years. So a lot of that has got deployed in the year gone by, and some of it in this year. Besides that, obviously, some of these strategic initiatives they will not only pay back in terms of efficiency, but also our ability and muscles to grow better. So the endeavor is to basically try and make sure that they also contribute towards growth and better efficiency. So, for example, let's say the high performance merchandising project that I'm talking about will allow me to manage this 2,000 and expanding network in terms of the right kind of merchandise, what sells where, and therefore the ability to do it more scientifically, and therefore the efficiency of that inventory in terms of generating growth, etc. So similarly on the e-commerce side, which is basically to drive growth, and simultaneously some of them will flow into initiatives, into efficiencies.
So, sir, would it be prudent to assume that the high level of investments would continue at least for the next couple of years that you're doing?
Yeah, I would say so.
Okay. And so my next question is with regards to the dividend payout. So if you see during the year, the dividend payout is almost 57% of the annual profits. And I think the last year also we gave a special dividend. So is there any change in the dividend policy, and can we see the dividend now being higher versus the historical levels of 25-30% dividend payout number?
Okay. So basically the board, while last year was a one-off kind of a dividend that was announced at that point in time, but this year is more normative. So I would say that that's in line with the policy. The board's policy on dividend is up to 60%. So we will have to see every year what ratio the board approves on this, but that's where the policy is. This year is more normative, so it's not a one-off.
Okay. And sir, if I can slip in one more question, with regards to the distribution front, you've been very aggressive. Even this quarter, you have added almost 200 towns out of the 300 towns added in FY23. So what is the outlook here? What kind of performance or contributions you're expecting from this part of the business? And with the inflation now normalizing, do you see growth reverting in this segment back?
Yeah, both of them we are looking at both the questions we are looking at very optimistically. That's why we are investing in it, not only in terms of the infrastructure that I've just shown you in the slide, but also in terms of manpower and capabilities. And also collection and merchandise that's required for that channel, which is very different from the exclusive business outlet, retail outlets. So yeah, we are looking at it very ambitiously and optimistically.
Sure. Thank you, sir. That's all from me.
Thank you. We have our next question from the line of Nitin Shakdher from Green Capital Single Family Office. Please go ahead.
Good afternoon.
Hello, Nitin, we can't hear you.
We have a next question from the line of Girish Pai from Nirmal Bang Equities. Please go ahead.
Yeah, thanks for the opportunity. Gunjan, if you look at the EBITDA margin in FY23 and compare with FY20, there is almost like a 430 basis point dip. A lot of it that is coming from other expenses being higher by about 100 basis points. Can you give some guidance of how that number is going to look like, other expenses? Were there any one-offs in FY23 which are not going to be repeated going forward?
At a larger level, no. The quarter 4, the last quarter did have a one-off, right? So there is some element of that one-off. But the other piece that is there on other expenses is to do with 2 or 3 lines. One is there is a mix that is changing, and therefore the contribution of channels like franchise, e-commerce as well as multi-brand have gone up, right? And that has a very different kind of a P&L. The second piece that is there is that some of the investments that we have put in, that has its own depreciation effect, especially the largest mention would be on technology side, Girish.
Okay, and you also mentioned about a VRS being implemented in one of your manufacturing units down south. Are the costs connected with that appearing in the P&L? Where exactly would those be?
They will flow through on the. I'm looking towards my finance guy, but I'm sure it will flow through in the corporate overheads. So that is where it should flow in. But basically, yeah, it should pan out over a period of this year, etc.
And would we see further VRSs going forward?
I can't comment on it right now.
Okay. Last question, margin. Athleisure apparel is going to be adding to your revenues. Do you think this is going to be margin accretive or decretive, or what's your view on that?
So all the three initiatives that I mentioned in the slide, and specifically apparel for sure, right? But even floats as well as red label, all are being aimed for margin accretive.
Okay. Thank you.
Thank you. We have our next question from the line of Ali Asgar Shakir from Motilal Oswal. Please go ahead.
Hi, Ali.
Yeah, hi, sir. Thank you so much for the opportunity. I just wanted some color on the revenue profile and revenue growth. So when I see your store addition over the pre-COVID numbers around 20%, and we would have taken some price increase plus premiumization combined would have helped us somewhere about 10%. So against this 30% revenue growth expectation probably that we were building, your growth, if I compare pre-COVID, is somewhere about 13%. Now, I take your point. You mentioned that, franchisee is about, 0.5, and we've seen about close to 250 odd franchise, which is about 10-12%. So, maybe 6% impact would have come because of this. And, but I'm just trying to get a sense that this along with, you also mentioned that lower price products are seeing some impact. Still, the gap seems, reasonably high. So against a 30, let's say if I take 6 impact because of franchisee, maybe, give or take 5-10% impact because of the low price product not doing well. Still, the gap seems reasonably high. So what is it, that has seen a relatively far lower revenue growth than what, probably we were anticipating?
No, the only other piece that I can add, but I cannot comment on the mathematics, but the only other lever that I can, or insight I can add to you, Ali, is that we have shut down about 90 odd COCO stores net, right, versus pre-COVID, which were unprofitable.
Okay, and they would have been very high revenue contributors.
Average, I would say, not necessarily very high.
Okay. Do you think, sir, we mentioned that the casualization sneaker trend is doing very well, but we may have probably in this shift from our existing to casualization trend seen some revenue loss in some part of the business, or do you think this is recoverable?
You would have seen some loss in, sorry, I missed that part.
So I'm saying that, the trend that we are now moving towards casualization, sneakerization, maybe some part, I'm not sure whether open footwear, formal wear, some categories you would have seen, lower revenue profile probably because we are pushing it lesser in the store. Has that been a factor which has led to this lower growth, any of those categories? I'm just trying to understand when we build a growth for the future, what part is recoverable?
Right. So the way the system works, Ali, is that and range and therefore a article set that does well automatically gets filled in, right, from a short-term horizon, which is at a store level, etc., and then from a range investment point of view, which is at, let's say, a horizon of a season, which is 6 months, right? So if, let's say, for example, we see Comfort doing well, then Comfort automatically starts getting more inventory, and Comfort starts getting more and more range. So similarly, you will see that across. So as I mentioned, you do see a certain amount of traction on premium, and that's doing well, right? The one that is on the lower end is where basically there is some amount of demand pressure, and which is what I responded to another query that was there in terms of, what's grown faster and what's grown slower. So that is where the piece would be. I would not exclude completely, but overarching, we would like to continue premiumization. So another example being like, let's say, even if it's open footwear, right? Clothes is a way of premiumizing open footwear. And therefore, the average ticket size of a consumer which was otherwise buying, let's say, flip-flops at, let's say, 300, 400 average selling price in our store is now jumping to almost 1,200 plus. So you are catching a consumer, you are offering more premium products, but you are not necessarily excluding them from offerings of 300, 400, but some of them are upgrading for sure. This is why it's being so well.
Got it. So last follow-up here is, so as we see the lower price point products recovering, should we assume that there is at least about 15% odd recovery in revenue that is foreseeable?
I can't project growth for you, Ali. We don't give forward-looking forecasts, but our endeavor is to make sure that while we see the market turning around at a certain price segment level, we continue our strategy as I had outlined in my presentation. So hopefully that should only add to our performance.
Excellent. And last question is...
I request you to come back in the queue, sir.
Sure.
Thank you. We have our next question from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, sir. First of all, wanted to apologize on that inventory calculation. It was wrong at my end. So you were right. It was 2% versus 4%. So first of all, wanted to register that. So my question is on franchisee part. So we have done a very good job on expanding the network. And usually if the franchise economics works out, then the same franchisee partners start expanding the network. So just wanted to know, are we seeing consolidation of franchisee owners who are expanding more franchisees?
I did mention that Tejas in my presentation, but first and foremost, thanks for sharing that correction. So I guess we are a little more relaxed on inventory now. But coming back on the point on, I had mentioned that in my presentation that there are 2 or 3 metrics that we look at in terms of, while we are going aggressive in terms of expansion, but we want a sustainable franchise model. And one of those is basically the profitability of our franchise partners. And the best outcome indicator of that is how many of them are opening up stores, multiple stores with us. So I think last quarter, 60% of our stores that got opened were with existing franchise partners. So that's creeping up all the time, and this is a good indicator, and that responds to your question also, I guess.
Fantastic. Second, sir, if I see our brand architecture and our premiumization journey, do you think that the current set of brands are can fulfill our aspiration to premiumize the portfolio, or you think that there are still some white spaces in our brand architecture where we'll have to launch or bring some of the overseas Bata's brand, Bata family's brand to actually kind of premiumize the whole or complete the whole pyramid here?
Yeah, no, there is, it's a never-ending task, ideally, if you look at it, right? And which is why you have so many brands in the market, right? Because there are various kinds of price and the brand value that is being provided by various brands. From our portfolio perspective, there are obviously gaps. And the initiatives that I've listed out in the chart in my presentation, whether it was Red Label, whether it was Power, that was a category, apparel. But hopefully it does well. It spawns off the Power brand itself and floats. All of these are basically attempts on that, basically trying to nail some of these kind of spaces where we feel that we have developed some expertise and are right to succeed.
Very clear, sir. Thanks and all the best.
Thank you.
Ladies and gentlemen, we request you to restrict your question to one at a time. We have our next question from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Hi, Ankit.
Hi, sir. So a couple of calls back, you had mentioned you have aspirations to do contract manufacturing for global Bata. In your next leg of growth, you haven't spoken of that. Has that project been shelved, or that is a separate thing which you will call out down the line?
I have not called it out because I don't have a tangible progress update for you. But Ankit, the progress and the work is not being shelved out. In fact, it is working even more aggressively. And as I had mentioned, I think even at that point in time, or maybe in a subsequent conversation or a call, right, that requires a lot of working. I think globally, Bata is very aggressively looking at a China plus one strategy. India is the largest sourcing base, even larger than China, right, for the Bata global organization, primarily sells in India, obviously. So there is a huge amount of capability. I think there is a natural fit in terms of what's required and what's available, both from a requirement perspective of trying to diversify out of China, as well as in terms of the kind of capabilities and the kind of network that we have in India. So wait and watch this space. We will obviously make sure that we update you once we have some tangible progress to be made on it. but we are working pretty aggressively.
Understood. Some second question is regarding clothes. The category has picked up post-COVID. We have seen Crocs, who is the market leader, growing aggressively as well. And this is the first brand.
To come back in the queue, sir. Thank you. Ladies and gentlemen, you are requested to restrict your question to only one at a time. We have a next question from the line of Akhil Parekh from Centrum Broking. Please ask your one question.
Thanks for the opportunity. Question is on the employee expenses front. If I look at it as a percentage of sales, is broadly in line with FY20 numbers. And this is despite some of the activities. Hello?
Your voice is breaking. There's a lot of disturbance.
Audible now?
Yeah. Which number is in line with 2020 number?
The employee expenses as a percentage of sales, if I look at it, it is broadly in line at 12%. And we have been doing some kind of a flexi staffing to reduce that cost, basically. If you can highlight or throw some light on, what percentage of our staff is on flexi, and do we expect any further cost reduction on the employee cost front for next 2 years?
Okay. So directionally, yes. Obviously, I think COVID did have its impact. Otherwise, these percentages could have looked a little better. But I'm sure some of these initiatives will pay back over a period of time going forward. There are 3 levers on this, and it at a very macro level. One is flexi in terms of retail manpower, right? That as of now stands at about, it varies per quarter depending on seasonality of the business, etc., but stands at about, let's say, about 15 to 18%. The aim, ideally, this should go to at least about 25% for status quo. So there is headroom there. The second one, that's the lever, is basically in terms of the backend, and therefore, the supply chain piece, the 3PL, wherever we can, outsource non-core areas, get in more efficient partners to collaborate with, etc. I have updated you on one of those warehouses that we have moved, VRS in one of our factories, and there will be multiple such other, initiatives down the line. The third one that's there is basically on technology. So whether it's HPM, whether it's ERP, whether it's, data warehouse management systems, etc., that we are setting up, there also we should see productivity increases coming through because of digitization itself. So all of these combined together will eventually help us keep this under check going forward.
Thank you. We have our next question from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity again, sir. So my question is with regards to the margins, if you see in Q4. So, we had done a gross margin of around 58.5%. And given the fact that, our franchisee contribution has been into a period, so shouldn't the gross margins should go down, whereas the impact could be felt at the EBITDA level, but shouldn't the gross margin theoretically be down? And how do you see this sustaining ahead?
Yeah, so technically you're right? And I think it's a question of a mathematical weightage and of various channels at various points in time. So even, let's say, for example, in e-commerce, if the e-store has got the maximum margin, right, the marketplaces will have at the gross margin level would be relatively lower, or a sales margin level, right? Obviously, the picture is very different at the EBIT level. So depending on the mix for those channels for various quarters, but eventually, yes, your mathematics will tell you that the margin will trend differently if the mix of the lower margin channels goes up. But then that will also get compensated by some of the expense lines below the margin line.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Nitin Bagaria for closing comments. Over to you, sir.
Thank you, everyone, for taking out time and joining us. Looking forward to interacting with you again. In case there are any further queries, you can direct them to us. We would be happy to answer them. Thanks a lot. Thanks, everyone.
Thank you. On behalf of Batliwala & Karani Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.